NovaPort Capital, we think investing is about trying to find, a recent return better than you get in the bank, better you can get for the risk that you're putting into small caps. So what we look for is 50% upside over 3 years. We try and find businesses where we see a sustainability about them, where we see an enterprise which has got something which, will have a resilience to it. It's got a good underlying business and franchise, but still some value growth over time. Those are the sorts of investments we're looking for. Although the obvious example is one which sadly is now a large cap, but has worked well for us for 10 years until it became a large cap, would be Fisher & Paykel Healthcare. Brilliant business, healthcare sector, delivering great value for customers, innovative, driving fantastic margins and return on capital and growing at a healthy clip as a result. It's a really interesting point because you can't you have to be careful about the difference between valuing a company and understanding the trends of value creation in a company. Now, valuing a company, that's about understanding what the cash flows and the return on capital is going to be and where the return on assets and return on equity is going to be over time. That hasn't changed. In terms of working out what are the fundamental drivers of value creation in a business, the market's very focused on that right now because we're interested in growth. So how are we creating value? And those metrics people are looking at total addressable market. How big is the size of the market this company can exploit? They're looking at things like the customer acquisition cost. How much does it cost to win a new customer in terms of advertising, Google ad search, upfront cash incentives? That's your CAC. Lifetime value of a customer. How much money can you make out of a customer if they stay with you for 4 years? Those sorts of things give you good metrics about what the value creation a business can get out of new growth, but it doesn't actually value the business. I'll give you an example of a stock which is a bit boring, but which we can put those metrics on which no one has in the past. And this is I think it's interesting because it shows how these metrics can be used to see where the growth potential is. MyState Bank or Auswide Bank. At this current point in time, these are boring businesses, people think, because they're small banks. But the actual total addressable market is trillions of dollars in terms of the mortgage market in Australia. The lifetime value of a customer, on a $500,000 loan is for 4 years $30,000. The acquisition cost of that customer is about $4,000. So you can actually see that there's a very attractive customer acquisition cost to lifetime value equation at the current metrics where you're able to get an 80%, 75% gross margin because interest rates and funding costs are so low. So there's a probably unusual deployment of that methodology over a sector which has been well known for a long time. It is interesting because, we do see a lot of that. It's becoming more prevalent today. Today you can become anything you want on Twitter. And then maybe if you tweet your lifestyle and send enough photos, you can actually have that lifestyle because you've made it for yourself. So you've faked it till you've made it. And that's been the case in the market for a long, long time. In the past, we might have called them money miners, mining the market. What it is essentially, hey, you've got a good story, you've got a good narrative. The reality isn't there yet, but if you put it out in the market and the market starts buying into that narrative, you can get a share price, a currency which is high enough. That means you can actually buy and create that outcome. One of the examples I put in a recent report is like Jack and the Beanstalk. If you can convince someone that my shares, my magic beans, are worth something, you can trade them for a cow, and that's real value. So you can create value by faking it, and actually it results in value creation. That is the job of being a fund manager. Is being able to understand whether or not this business has got legs. And the tools we've discussed before, the looking at the total addressable market, the gross margin potential, the customer lifetime value, they give you a sense of where the business is heading, but you've got to take an opinion of, is this product they're coming up with, does it have definable value? Does it fulfill a need? You've got to take a view on the CEO and the management team of a company. What experience do they have here? Have they been involved in this business a very long time and are passionate about what they're doing? Or is this sort of a bit of an idea they had a few years ago and they're exploiting it for what it's worth? When we look at chasing momentum in terms of share price or chasing momentum in terms of share value of value creation in a business, What essentially the investor's doing is they're taking a bet or a position that they'll be able to sell a share for a higher price in 1 day, 1 month, 1 year, 10 years' time than they can today. And that's normal investing day to day. The question that you've got to understand and assess is what are the rational underpinnings of that thesis, why they think they can sell at a high price tomorrow, in a month's time, in 1 year's time. Is it based upon an assessment of whether or not the business is realistically going to be that much more valuable, or is it based upon an assessment that someone else will buy the business because the share price is going up? So I would say that investing in momentum is not necessarily a bad thing. In fact, in many ways, it's just a rational thing to do. But what are the fundamental reasons why you think that momentum is going to continue? And that's where bubbles can become dangerous, because if there's the fundamental reason is nothing more than, I think someone else is going to pay more for it tomorrow, that's not a particularly well thought out argument. That's a really good question. In a sense, markets are always bubbles, because markets are our willingness to project a faith and confidence in the future. And even when I buy a BHP or a blue chip, I'm taking a faith and confidence in the future of that business. So to any extent, markets are always a bubble. The question is how big is that bubble and how resilient is that bubble? At this point in time, I would say the best gauges of how big a bubble is the exuberance of markets, the confidence of markets, and the willingness of markets to project extremely optimistic outcomes into the future. At this point in time, I'd say the market is quite optimistic, and that bubble is probably more inflated than usual.